I just want to start there, Kyle, in terms of what your impression as a venture capital investor was to the palace intrigue at OpenAI.
Yeah, I think there's a lot of cloud around what's actually going on. I think generally speaking, you have an industry that is receiving a significant amount of equity dollars. So this year alone, you'll see about 21% of venture capital flow into the AI space. I think what that really indicates, as it does generally when you've got an emerging market, there's a little bit of FOMO. I think there's going to be a lot of winners. Investors are trying to make sure that they get in early. But you've got venture capital flowing to a lot of other industries as well. We're on pace to exceed 2020 right now in VC dollars deployed, which is saying something, particularly with the narrative out there that says something a little bit different.
Well, yeah. I want to pick up with just that, and we will go into the non-AI parts of venture capital where a lot of dollars are going. But just sticking on that front, it seems like the big takeaway from today's news really was that Microsoft ends up the winner in any which way you cut it, that the big tech giants continue to consolidate a lot of their power. How do you avoid that when investing in a smaller upstart firm that might be an acquisition target or might just be replicated by another company?
Yeah, so I mentioned it. There's going to be a lot of losers. And one way that we mitigate risk lending to companies like this is by separating ourselves, at least one or two steps. And so what these companies have a lot of CapEx needs. Clearly there are GPUs that they're trying to acquire and finance, a significant amount of GPUs, and then there's a significant amount of energy that they need to produce to run those machines. And most of these companies are figuring out ways to provide more efficient energy. And so what we do is we get in and we'll provide equipment financing, right? We'll provide financing against GPUs or different types of machines necessary, CapEx, to cover the CapEx of these companies. And so less connected to the volatility of say, the value of an H100 or A100, and more so focused on equipment that these companies need to use that's mission critical to run their business.
Do you invest in any equity in the venture capital space?
Yes, it's a smaller portion of what we do. The majority of what we do is senior secured loans to venture-backed companies, and we do that by just how I said it. We take the risk out of lending to venture-backed companies by removing ourselves from the direct volatility through collateral that is secured, equipment, et cetera. Yeah.
Do you think that in some ways debt is the new equity when it comes to returns in the venture capital space? I've heard this from a growing number of private markets participants that in general, debt is taking on increased characteristics and returns that private equity used to take.
So we've seen 7 straight quarters of our yield on our investments increase. We think that's going to continue. We've also seen in that same period of time valuations significantly decrease. In our own portfolio, half the portfolio's raised capital this year, over $2.5 billion, and it's almost exclusively come with damaging and dilutive down rounds. And so what that means for a lender, and if you're investing in this space, is a really interesting upside potential. And so, I don't know if it's necessarily the next, the next equity, but there's going to be some opportunities like there hasn't been over the last couple of years for some upside and valuations increasing.
How big of a concern, just thinking back to the OpenAI saga as it unfolds, and as you said, we don't know a lot about what actually happened. How much does this highlight an increasing key person risk that we see in a lot of the startups where it is a cult of personality driving a lot of the ideas and a lot of the enthusiasm?
Yeah, I think if you're talking about startups, Series A companies, seeded companies, that's probably a little bit more important than where we play, which is more kind of pre-IPO, where you've got a full team, full executive team, CFO, chief accounting officer, CEO, COO. So I think that there's going to be some losers certainly in that earlier stage, Series A, et cetera. You'll see where we play a little bit more mature companies that are well into revenue, a little bit less volatility.
How quickly are you expecting the IPO cycle to really open up so that you can sort of cash out? Or is that not even in the cards at this point and you have to kind of get capital in other ways like secured lending?
Yeah, so, historically it's been about a third. About a third is IPOs that we exit our deals, a third is refinances, and then a third is kind of M&A type activity. So we don't count on it by any means, and it kind of shifts, right? And so you're starting to see more consolidation right now, PE groups coming in, and if they can get the right valuation, coming in to acquire controlling stakes in companies, and we're getting some repayments. So it ebbs, it flows. We don't count on an IPO for repayment. It's really a combination of those three things and just repayment. payments. What happened a year and a half ago in the VC market is, companies had to tighten up their burn. They had to figure out how to get profitable. And I think what you're seeing in lower middle market right now is something that already occurred, a year and a half ago in the VC-backed space.
Where would you say we are in the cycle? Because a lot of people are saying we're late stage in the public markets. Where are we in venture capital?
Yeah, so somebody asked me the other day, they said, what do you think we're going to have a recession? I said, well, if what we just went through in the last 18 months is in a recession, then I'm not quite sure what is. So significant valuation decreases, tighter liquidity, and companies really having to figure out how to survive for the next 2 to 3+ years. And so I think we're probably through some of the cycle in the VC world. There's probably going to be some more volatility, but for the most part, we're just not seeing extreme volatility within the portfolio.